Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at assets, long-term charts, asset pricing, market conditions, what could potentially be coming. And I'm just going to go over again kind of what that looks like, how it's progressing, how it's potentially going to play out. And keep in mind that people can be bullish and bearish at the same time on different time frames. I am very bullish on an inflationary move that is coming, and that had an initial surge. But these things come in waves. You have to keep that in mind. They don't come, and it's just not one big move. And some people, when they take shorter time frames, they'll try to time the shorter time frames. I'm taking kind of the decade-plus long view and say, look, this is going to be inflationary, and that's the way that I view things. It doesn't mean I'm going to have to try to time the short-term stuff. That's not my thesis. Yes, I'm going to try to time my purchases. Yes, I'll carry more cash, perhaps, or stack some more cash, or I'll buy different assets based off of the cycles. And sometimes I'll rebalance the portfolio to take advantage of what I think is a short-term thing. But I'm not sucking all my money out trying to time one asset class to another asset class to another asset class. It's too stressful to do that, at least in my opinion. So let's dive in here. I'm going to give you my financial opinions on kind of commodities and different types of commodities and what does well under inflationary timeframes. So what I've got here, hopefully you guys can see this. So this is chart. It is the correlation of real and financial assets with inflation since 1950. And this is the higher return based off of that inflation. So real assets, commodities, platinum, real estate, diamonds, gold, collectibles, farm, UK farm at least, treasury bills, cars, UK house, palladium down here, silver is even below palladium, art, US farm, and US house. And then we've got ones that just long-term government bonds do not do well under highly inflationary periods. So one could say by looking at this chart here that when platinum outperforms gold, we are in an inflationary environment. Conversely, you could say that if you expect an inflationary environment to come, you would expect platinum to outperform gold. So platinum would be the preferable metal to invest in over gold if you think we're going to go through an inflationary environment. All assets get priced differently under market conditions. So if you've got different market conditions, assets and the rotation of money moves between things differently. So in an inflationary environment, money or money flows rotate towards real assets, commodities, and platinum. And it rotates away from long-term government bonds. And that is where you want to focus your efforts on, is understanding the market conditions and how they are changing. We can use ratios of these different assets against each other to see how they are changing. And we can also look at interest rates and other things to gauge potentially where the markets could potentially be going. Now, if we look at charting, I've got platinum up here. Platinum is an inflation-sensitive asset. And when you look at this, this is on logarithmic. We've got a consolidation period that is this guy here with a false breakout, blow-off, capitulation bottom. We have a break of this pattern to the upside, a retest, and now we're just starting to work our way higher. What this is signaling to us is that platinum, from a human behavior standpoint, looks like we could go a lot higher. So that looks good for what would be an inflationary environment. That's what this chart is telling us could potentially be coming. So then we want to look at the ratio of platinum to gold, let's say, and platinum to gold, get off logarithmic here. We've got this downtrend, and this downtrend ended here. We broke out, and then we did a retest, and then I think we're going to work our way higher. That doesn't mean that it's going to happen immediately. Doesn't mean that right here that we're just going to rocket on up. We may pull all the way down here again before heading higher. There could be a short-term problem in the markets where inflation is not a problem. It's actually disinflation, or even a problem with credit being destroyed in certain areas. But I think on the big picture, longer term view, I think that platinum will outperform gold based off of the conditions. So what conditions would cause this to happen? Well, running massive deficits is inflationary. Not being able to afford the interest payments, which would create deficits, could be a major driver of inflation. They may have to do quantitative easing to keep interest rates down. And those are all factors that you should be taking into consideration when investing, if you're investing for a 5 to 10 year time frame. I also think platinum to palladium looks good, and same with platinum to silver. That is everyone knows my views on platinum and the potential outperformance. Now, when we look at some of the market conditions, one thing that sticks out to me that I always go back to, let me see if I can find it here. It's in this. So there's a couple of things here. We've got the long-term inflation rate, looking at it from a very long-term picture. We hit our head on this, and if we break this to the upside, guys, we could see a very inflationary period. That would be a breakout from a downtrend line that started in 1920 all the way to almost a breakout of 2022. That's a 100-year downtrend line. And remember, the larger the trend, the bigger the move to the upside, which means we could go through a very inflationary period if we were to break this to the upside and maintain above it. That is also coinciding with this chart that I'm going to show you. This is the PPI to CPI ratio. So what does that mean? That's the producer price index divided by the consumer price index. When the PPI to CPI, when this goes up, you're in an inflationary environment. It means that your producer prices are outpacing your consumer prices. And what that means is more inflation that you see in the consumer price index. What we have here is a double bottom. We hit our head on the top here of this trend line coming down. We've kind of backed off. This here is a gigantic pattern to potentially break to the upside, which means the producer price index will continually outperform the consumer price index, leading to inflation that we've never seen before as human beings that are alive. That could potentially be something that is driving that. Now, what is causing that problem? Well, I think it's twofold. Twofold that's causing this chart. And that's where all the value is, guys. The value is in understanding what is creating these patterns. It's not just humans interacting with each other. There's reasons that the humans are trading like this. There's reasons that humans are creating this entire chart here. When you're in a surplus of oil and you've got tons of energy to grow into and commodities to grow into, this is going to trend lower. If you hit commodity shortages and you hit energy shortages, this is going to trend higher. Our first little baby move was in the 1970s, and in 1970 we hit peak oil. Peak oil in the United States alone, not in the world, just in the United States, created this big move, which also created problems around the currency and a huge run to gold. But that only happened in America. This here is worldwide, guys. It is a completely different ballgame. And if we hit worldwide oil production problems on the supply side, we could see very high rates of inflation. This is also paired with a dollar that people are de-dollarizing throughout the world. De-dollarization will also cause inflation in dollars. So it's the combination of multiple things. It's the combination of energy, potential energy shortages, potential commodity shortages as well, as in copper, cobalt, nickel, et cetera, and the de-dollarization. The dollar could get smoked here. So we have this gigantic kind of big picture view of what could potentially happen with inflation and the dollar and all of those things. That's kind of the big picture view. The second portion is, how do you play it? You know, I hear a lot of these macro calls. No one talks about how the heck can you play this? I mean, if we think that we're going to an inflationary environment, if we think that we're going to have potential commodity shortages, that means that a lot of these companies that just fling commodities through their facilities, they may not be that great of a play, because they're going to be fighting against each other for commodities. They're going to be fighting each other. They're going to be trying to outbid each other. So commodity prices are going to continue to go up, because the companies are going to have to continue to get commodities to fling through their factories. And they're going to start bidding wars against each other to keep that going. So you want to go upstream. You want to go to the commodities. You don't want to be the ones that are consumers of commodities. You want to be the ones that are producers or the gatherers of commodities. I know we're just gathering it from the environment, right? So those would be good. But if you have energy shortages, or if energy is short, then the commodity companies may not be the best if they're mining companies, because they use energy as an input. Those companies are more or less energy converters, so they convert energy into commodities. And they use big trucks and big machines and crushed rock and all sorts of stuff to do that. So if energy is short, well, you could have the commodity prices go up, but their margins of the companies may not go up that much. So then you have to keep going further and further up the chain of where it is. So now you're looking at energy companies. But energy companies, they could potentially also have wicked inflation, because everything that they use and consume when obtaining energy in their, either in the energy service companies or the drilling rigs and all the parts that requires and all that, well, that could be short too, if you're having problems with commodities themselves. So then you want to keep going up the chain. How does one preserve wealth in an environment like the 1970s? We're like in the combination of 1940s and the 1970s. 40s from the debt perspective, and where we are from lowering interest rates to an increasing interest rate environment. We're basically just bottoming out. That's very 40-ish, 40s-ish time frame. The 70s come into play from an energy crisis, but this is happening worldwide. So 70s was contained to America. What's coming, I think, is worldwide. And we don't know how high energy prices are going to go. That's the feedstock of everything. And I don't know how short it's going to get either. It looks pretty bad, in my opinion. And we may not ever pull ourselves out of it completely. We may have to continually price people out of the system. That may be something that we have to do, if there just isn't enough to go around for the demand that wants the product. So we'll just see elevated increased prices for a long period of time, and until we get supply response, and we'll see if that supply can respond. So generally, from a risk perspective, stock markets are priced off of future earnings. Future earnings are priced off of future energy consumption. If future energy consumption is constrained, that means that things are all overvalued. The earnings are going to be at question, because those stocks have a future price to earnings ratio, which is 15, 20, 30, 40. If energy is scarce and we don't see a path to basically provide cheap energy, then those companies are all overvalued, because the future earnings are now they're in question. So energy, I think, is a good spot to be looking at, because that is the problem that needs to be solved. That is where my head is wrapped around. Also, physical metals, I think, will be the easiest way to play this, because if you have future energy problems, and depending on how scarce they get, that means that anything that converts products using energy, which is basically all companies in the world, their product prices have to go higher. And you don't have to speculate on the margins of the companies themselves. You can just speculate and say, hey, you know what? I think the price of commodities in general are going to go higher. So what you're speculating on is that the cost curves are going to continually go up because of inflation. And inflation is being driven by energy scarcity. So if you think that energy scarcity could be a market condition in the future, that means that you can buy things today with cheaper energy prices, which will now be more, it will be repriced to a more expensive time because the embedded energy to get precious metals, to get that item, that real asset in the world, will go up to replace because of the embedded energy costs in those things. Some people are looking at that and the embedded energy that it took to build some of these gigantic oil rigs, offshore oil rigs, and they're putting a lot of money in the offshore oil rigs because as energy gets more scarce, that's what's going to go up in price, and it's going to be hard. It's going to be a barrier. It's going to be a moat, a barrier to entry to build brand new offshore drilling rigs. So the embedded energy and the cost it's going to be to build drill ships and these offshore rigs is going to be immense, which is going to be a barrier to entry for new companies and new drilling rigs to be built, especially if everyone's anti-oil. So I think there's a really good setup in oil, very good setup in oil on a longer term time frame because everybody thinks that they can solve the energy crisis using renewable energy, an electricity-based solution. But here's the problem. If commodities get really hard to get out of the ground, if the ore grades are declining like they are, and the energy consumption to get them out of the ground continually increases at exponential paces, it means that the option that people are pricing in the market, they're pricing in that renewables and electricity can solve the problem. If we cannot build enough renewable vehicles, people are going to continually use gasoline-powered vehicles, which I think is going to be the case. If that is the case, and we hit renewable metal commodity problems, we're going to continue to make hybrids and other things that are less energy mineral intense, which means more oil and gas demand for longer. And I don't think the market is pricing that in at all. So that's the setup, in my opinion. And I think that the lowest risk, easiest way to play it is through precious metals. Because when people figure out that option A is not working, and option B, we haven't been investing in increasing our oil production, we're going to squeeze the crap out of oil, guys. That's what this chart is telling us is going to happen. This chart is telling us that we're going to see an oil squeeze that we've never seen before in history with this double bottom here. Now, that doesn't mean it's going to happen immediately. Doesn't mean that this summer it's going to happen. It's going to take years for this to play out. We could go down like this and then work our way higher, whatever the path is. I don't think we can go to 120 million barrels a day. We want to go to 120 million barrels a day over the next probably 10, 20 years. I don't know if it's there. And everyone's thinking, oh, we'll just do these electric vehicles. The commodities aren't there, guys. We got to yank this stuff out of the ground in copious amounts. That's the setup. And if this gets worse, like if this gets bad enough, people are going to start questioning the currencies. Because what you're going to get is this is what you'll get. You pull up an M2 money supply in relationship to GDP, and they're trying to shrink this M2 money supply to keep this all in balance. But your GDP is going to go down, and your M2 money supply has to go higher by the design of the system. So what you'll eventually see is you're going to see this go higher. You're going to see your M2 money supply outpace your GDP, which is going to be inflationary. It's already doing that. That's the trend since 1996, 97, where it bottomed, and the trend's been higher ever since. If your M2 money supply has to grow by design, or the system will literally collapse on itself through a deflationary collapse, which they won't let happen. They'll just print money. They've always failed inflationary. And your GDP collapses because your energy isn't there. That is where things are going to get really interesting. And that's where I think precious metals will do incredibly well because, one, you've got no counterparty risk with it. It's gone. You just own the final payment, so to speak. And people are going to be running away from dollars, away from fiat currencies to something that has value to store wealth. And if the energy supply is, all this is, the whole system, the way that this system works is you need to have the M2 money supply go up based off the design of the system to pay the debts off. And then you need GDP to accompany that growth. That's what keeps the whole system in balance. And if you don't have the GDP growth, your M2 money supply's got to grow. You're going to get this massive inflationary problem. If you have a massive inflationary problem around the world, this is going to be worldwide because energy is going to impact everything. Then you're going to have everyone run at the metals at some point. I don't know when that's going to be. It could be 10 years from now. It could be 20 years from now. I don't know the exact timing of it. But that's where people are going to run. And they're not going to, I don't think they're going to run to cryptocurrency. If that's me, I could be wrong. Oh, he's going to be wrong. Well, great. You're going to take a massively energy intensive cryptocurrency to do transactions in an energy costly world. I don't know. But that's what I've got for today, guys. I'm just kind of talking off the top of my head of what I think might be coming in the different market conditions. This is a big, long-term, big picture view. It doesn't mean it's going to be like that 3, 4, 5 months from now. We could see a big pullback in everything based off of what is the interest rate. So if you look at the interest rates, this is what I'm basing it off of. If you look at the 2-year interest rate, this is the 2-year. See how we're diving down here? I mean, yeah, we're getting a bounce here, but this is something to watch. And we very well could do kind of a shoulder, head, and then another shoulder that comes up, and then we rotate lower. And I think this is it's gonna do that even when when oil gets really short. We're gonna have movements up. In a system that will collapse, your interest rates are going to go skyrocketing higher because nobody's going to want to hold bonds. But there's going to be, it's not going to go up in one straight shot. It's going to break. We're going to be breaking these like a downtrend line, which we did here, and then we're probably going to come back, and then we're going to break up again. And this is going to be one big bull market in increasing interest rates over time. But nothing's going to happen immediately. It's going to take time, guys. It's going to take time. So that's what I think that's coming on a big picture view. And I look at ways of how to invest based off of that big thesis or paradigm outlook. Could technology come and solve something? Yeah, it can. But technology, I don't think is the answer. It's generally the problem and the downfall of every single system that we've ever had. Complexity of a system is what makes things vulnerable and weak. But that's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website if you guys want ideas around how to invest about what I was talking about on a long-term basis. We also have shorter-term stuff too. It's mainly around precious metals at this time. And that's what we've got. And don't forget, we've got a 5 p.m. Mountain Standard Time Sunday meeting for everyone who's a Platinum member on the website. We'll see you there. Bring your questions, and we'll catch you next time. This is Finding Value.